Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending May 12th, 2023. Looking at the market indexes for the week, the TSX, S&P 500, Dow Jones, and Russell 2000 were all down. Nasdaq was the only major index up for the week, mostly on a strong Thursday. Gold was down for the week. Oil was down to $70 per barrel for the week. Looking at Canada, last month, Ontario and the Government of Canada secured a historic investment from Volkswagen, Europe's largest automaker. Volkswagen is investing $7 billion to establish its first overseas electric vehicle battery manufacturing plant in St. Thomas, Ontario. How big of a deal could the new Volkswagen battery plant be? The transition from the internal combustion engine to the EV era is a significant leap forward in technology. The standard rule of thumb in automotive is that each assembly job creates as many as 10 jobs down the line. The plant will cost the government around $13 billion in subsidies, but the numbers are mind-boggling in terms of employment, secondary and tertiary jobs, and taxes that will support or generate. The government will make the subsidy money back in no time. Looking at the United States, there was a US Consumer Price Index release on Wednesday. They've made progress, but inflation remains sticky. Monthly numbers aren't showing much of a downward trend towards a pace consistent with the 2% goal represented by the dark black line at the bottom of the graph. The numbers are pretty much as expected and flat. The only good news was the year-over-year headline inflation, which came in under expectation and better than March. So the US inflation is now into the fours. The core CPI year over year came off from the previous month's reading. Since it's generally accepted that the inflation coming down from the nines to the fours is the easy part, there is nothing here to give the US Fed the push to start cutting rates, since inflation is flattening and at a much higher level than the target. Real wages came in at 0.1% higher over inflation, so wages are also still increasing significantly. With inflation still high, the Fed could cut interest rates if there was a significant recession, but being forced to cut rates in that situation would cause fear in the markets. The other reason to lower interest rates would be in case of financial instability, such as loan defaults, especially in real estate, either commercial or residential, where people were not able to handle the higher rates and would default, causing further economic issues. Ideally, inflation would keep coming down and there'd be no recession or a mild one, and the Fed could cut in 2024 because it didn't need the interest rates to be so high anymore. As it stands now, after the release of the CPI report, US rate futures have priced in a 92.6% chance of no hike and a 7.4% chance of a 25 basis point rate increase at the next central bank meeting in June. US banks are, as expected, reporting tighter lending standards and a weaker demand for loans, as expected, which will have a negative effect on the economy as less money moves around. This could lower the need for US interest rate hikes. The new worries for smaller US regional and community banks are now commercial real estate exposures. Commercial buildings continue to go unleased due to remote work when landlords are unable to renew leases. The main area of concern is office real estate, where vacancies are now at the highest level in 30 years. Low occupancies and rising interest rates mean property valuations are falling. The loan defaults may increase, causing problems for banks with those loans. Add to this the fact that about 25% of CRE loans will need to be refinanced at higher rates in the next year, which means landlords may choose not to do so and sell their properties instead, causing a fall in the market. The overall situation also leads to a lowering lending level for commercial real estate, slowing the economy, but at least lowering the need for interest rate hikes. The more desirable office locations have low vacancy rates. The problem is also more serious in some cities than others. In particular, the technology industry has embraced the quote, work from home more than other industries. So cities like San Francisco have particularly high vacancy rates. So while there will almost certainly be defaults, the exposure isn't nearly as widespread as it was in 2008 with subprime lending. It's also likely that regulators and the Fed will intervene quickly if the risk becomes systemic. The US, quote, neutral interest rate is stated to be 2 to 3%, neither intended to slow nor support the economy. Currently, the interest rate is at 5 to 5.25%, significantly higher. I would argue the neutral rate is much higher in practice, however. Historically, we are about 1% into the restrictive territory, being 1% above the natural neutral rate. The bond market is pricing in 3 US interest rate cuts for the back end of the year, which many people, including myself, do not believe. Investors didn't care for what they saw out of Disney earnings Wednesday, sending the stock down more than 5% in after hours trading. The company's streaming operations posted a loss, albeit smaller one than expected, as Disney pushes to make that business profitable. The company also predicted a wider loss for its streaming services this quarter. Disney Plus actually lost subscribers during the most recent quarter, but revenue per user was higher thanks in large part to recent price increases. The streaming market's growth may be flattening, with growth being over. The company's overall revenues came roughly in line with Wall Street expectations, and net income just short. Microsoft is putting pay raises on hold for salaried employees as the tech giant continues its cost-cutting efforts. The move comes after Microsoft said earlier this year it will cut nearly 5% of its workforce. It's difficult for employees to ask for raises amid layoffs. Last year, the company beefed up its budget for merit pay increases and stock awards as inflation surged. Quote, "We will maintain our bonus and stock award budget again this year. However, we will not overfund to the extent we did last year, bringing it closer to our historical averages," end quote, CEO Satya Nadella said in an email to employees. Performance bonuses for executives will also come down significantly, he said. Big tech companies in general are trimming costs and jobs after a year of share price declines that followed a period of rapid growth during the earlier days of the pandemic. Electric vehicle maker Rivian stock jumped 6% in off-hours trading after the company posted a narrower than expected quarterly loss after the close Tuesday. The company, known mainly for its R1 pickups and SUVs, also said it is on track to meet its production outlook of 50,000 vehicles this year, which would about double what it produced last year. It also intends to continue its focus on keeping costs in check. Airbnb plunged over 13% in pre-market trading Wednesday after the online travel company reported better than expected Q1 results, but issued a disappointing Q2 revenue outlook. Looking at some bits and pieces, Chinese export growth slowed in April as global trade cooled, underlining the importance of domestic spending as the main engine of the nation's economy after 3 years of strict COVID-19 controls. Exports rose 8.5% in April from a year earlier, China's General Administration of Customs said Tuesday, faster than the 6% pace expected by economists polled by the Wall Street Journal, but weaker than the 14.8 year-over-year jump recorded in March. Customs data released on Tuesday showed that Chinese imports declined sharply in April, indicating that the domestic demand in the world's second biggest economy remained weak despite the lifting of the COVID curbs. Finally, turning to next week, companies reporting next week. On Monday, we have Constellation Software. Tuesday is Home Depot, Baidu, and Lithium Americas. Wednesday is Tencent, Cisco, Target, Cureleaf. Thursday is Walmart, Alibaba, Lightspeed, and Canada Goose. Economic events next week. On Tuesday, we have the Canadian CPI numbers for our inflation for April. On Thursday, we have US initial jobless claims for the last 4 weeks. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.